SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Ladies and gentlemen, welcome to this SUERF Baffi Bocconi e-lecture on the macroprudential challenge of climate change. Despite important progress made in climate risk mapping over the last years, considerable uncertainty remains about how climate change could imply systemic risk. The latest publication of the ESRB and ECB project team on climate risk has sought to address these knowledge gaps and the case for macroprudential policies in the European Union. The report outlines how climate-related financial vulnerabilities in the European financial system might include correlated shocks, hazard interdependence, as well as significant portfolio overlaps. System-wide scenario analysis suggests climate risk could initially result in abrupt market repricing, inter alia affecting institutional investors, but then leading to firm defaults over time, which would in turn affect banks. Thus, macroprudential policies have a role to play in addressing associated systemic risk as part of a broader policy response to address the financial impact of climate change. We have a team of top expert speakers with us today. Paul Hiebert is head of Systemic Risk and Financial Institutions Division at the European Central Bank. And Paul will present key findings from the ESRB-ECB report. Then, Fabio Natalucci, Deputy Director of the Monetary and Capital Markets Department of the IMF, and Irene Monasterolo, Professor of Climate Finance at EDHEC Business School, will offer comments of their own. My name is Ernest Gnan. I'm Head, Monetary Policy Section, Oesterreichische Nationalbank and SUERF Secretary General. Without further ado, I hand over to Paul.
Thanks so much, Ernest, and thanks for the invitation to share our work with you today. And I'm very happy and honored that both Irene and also Fabio have also volunteered to also discuss the work and provide their own perspectives, which I'm very much looking forward to hear. So I think you gave a very good introduction as to the work, so I don't think I need to give you any more about the nature of it. It's really about understanding how climate could present issues of systemic risk and therefore motivate a case for macroprudential policy. So what we intend to do, we have done this report, what I intend to do in this presentation today, just delve into a bit more of the specifics of this upfront introduction. And note that it is quite a comprehensive report. So I will give an overview of some highlights. Of course, there's much more there. And I think, as Ernest showed you, it's quite a thick document, well worth reading, coordinated by myself and Jean Boissino at the NGFS Secretariat, and benefiting really from almost entirety of the ESRB membership, which is relatively large. Now, what we've the way we've organized this today is to try and give you an impression of how are risks distributed in the financial system, and that's more the cross-sectional dimension of systemic risk, if you will. Then move in a second part to how are risks evolving in a financial system or building up. Another impression could be there the time series dimension of systemic risk. We're calling systemic risk as these two dimensions. As you probably understand with these, I'll be moving to try and map those to macroprudential policy in the fourth part. But first, I'll talk about how systemic amplifiers could imply that some of the ways we're measuring the risks, granular data sets, I think very detailed analyses, might underestimate the potential for them to be amplified in the system. So the small concentrations, risk buildups, which appear at prima facie to be potentially contained, could actually be much larger in terms of systemic losses. And of course, I'll summarize at the end. So with that in mind, let me launch into the slides, and I'll run through them. And then, of course, very happy to hear the views of both Fabio and Irene. So first, I'm thinking about a framework. How do you organize when you're thinking about risks in their distribution in the cross-section? So sort of a static view on risk, so their evolution in the past, not looking forward, but nevertheless how they've gone up to now. I would say you have basically the thinking we've espoused in this report is we've moved a bit away from what we've done in previous years, which is the exposure dimensions, the left-hand column. So taking very granular data sets, so address level data, firm level, even within sector questions, mapping these to corporate fundamentals, mapping these to financial exposures. Was, I think, very detailed work in the past. What we've done this year, and we've tried to further, it's the idea of thinking about how does that translate really into financial risk. So exposures need not one-to-one mean financial risk, and indeed there can even be amplifiers in the world of financial risk. So that's really, I think, our homework in moving these columns from exposure to risk. Now, just going through this briefly in terms of a framework, I mean, the top row is really about the real sector. So households, governments, firms. And exposure-based metrics there, we want to think there about how we construct them and institutional reach. Interestingly, I think we've had much more work on corporates. That's where the data are. But as you know, there's this lamppost problem. You don't want to just look where the data are, but you need to think more broadly, how could risk materialize? So we've done a bit more work. I won't speak about it in detail today about households and also governments, borrowing from the work of Irene and also Stefano Battiston on the sovereign space. Now, in the next row, we think about financial sector risk. And that is really about how does all of this translate into what's going on in the financial sector broadly, not just banks, but also non-bank financial intermediaries, namely insurance companies, pension funds. And then the last row is, I think, really one of the key ones when it comes to a macroprudential focus, is thinking about system-wide dynamics. And that's risk propagation on the one hand, systemic amplifiers, so things that Ernest mentioned in the intro, clustering of defaults, contagion, common holdings, but also thinking in the report is somewhere about this, about risk sharing. It's not just that we want an autarkic system. Indeed, distributing risk across the system is good. The only issue is sometimes it could embed also potential contagion and spillovers. It might also involve some risk sharing. Now, I'm going to focus today as a systemic risk hat. We're usually in this world much more about the risk propagation elements, but of course there are risk sharing elements not to be negated. Now, with this in mind, let's talk about physical risk exposures before I get to the financial translation. And this is mainly work we had done in a report in 2021. And that was the idea that physical risk seems to be very much a regional or geographic concentration issue. So if you look in the left-hand side at firms throughout Europe, each dot is a firm here, and you look 20 years ahead with a physical risk score, where do you see potentially that firms have high present or increasing report or exposure through time? So the red and the yellow, deeper yellow, and you see that it seems to be predominantly in Central and Eastern Europe and the South. Now, in the south of Europe, it's mainly about heat stress, elements of water stress, and in Central Eastern Europe, flooding risk. And if you go in the middle, I think what's interesting is take that away from firms and bring it into the sphere of banks through credit registry data, so very detailed data. So we have 1.5 million firms here, and we also have very many banks also in the mix too, in the thousands. And what you see here is ultimately these bank exposures are not necessarily so meaningful for any specific physical hazard, but if you take the combined elements of physical hazards, all of them, you see that the last column in the middle chart is quite significant. Around 30% of bank exposures could be exposed. And the right-hand side chart is that the insurance protection gap seems to be meaningful. And that came as a bit of a surprise to us. Around 65% or 2/3 of these physical risk hazards are simply not insured in euro area countries. So let alone emerging market countries, you'd expect in a developed market much more might be insured, and indeed that's not the case. Now with this in mind, we also did some work on exposures on transition risk and their evolution in the past. And what we've seen is that bank loans seem to be relatively stable in terms of stratifying firms, low, medium, and high emitters. So in other words, the blue, yellow, and red here. And we see that bank loans are relatively stable in last years, and a lot of high emitters in the mix, so the majority. And if you look at what's going on in securities holdings, banks, insurance companies, pension funds, or investment funds, you see a little bit more adjustment. But nonetheless, we still see a situation where the high to medium emitters are still quite dominant in the mix. I think what's important is, whereas on the physical risk side, I talked about regional and geographic exposures, transition risk seems much more sector exposures, either across sectors. So looking here at the climate policy relevant sectors, mining, manufacturing, trade, and real estate, these types of things, identified by Stefano, Irene, and their co-authors. What we see is that the mean of these firm level carbon intensities is quite different across sectors. But also what's interesting is the cross-section is quite different, and you see that many emissions efficient firms in the mix, as well as emissions inefficient firms, such as those sectors even overlap at some stage. So granularity is key in understanding where these risks might lie. And of course, financial markets, if they're looking at this, will likely be punitive when it comes to outliers. Now, what we've done in this report is, I think, interestingly taken the element of projected, so probabilities of default. And probabilities of default, the financial sphere, which are not necessarily related to the climate sphere, and bring them together and ask, where do you have a combination of climate risk exposure and potentially high PDs in the financial space? Now, here, for simplicity, we do it at the sectoral level. You could do it at the firm level too. In the level of sectors, you see electricity, and particularly manufacturing is the one where we see a marked increase in the last years. And with COVID, we don't have in the mix here in this particular one. I can tell you COVID in 2020 and 2021 had a marked impact. I think what's more interesting is the right-hand side is more about the distribution, the cross-section, such that if you look at probabilities of default of firms' market implied ones, you see that climate risk exposures are quite closely related to them for areas like mining, where you have the yellow and the blue lines matching here, where the yellow is really about climate exposures in loans versus standard financial PDs, the multiplied through there in blue. So what you see is areas like agriculture, you'd see higher PDs even if the climate risk exposures are not so meaningful. You could imagine the PDs, the financial risks, could amplify those to some extent. So hence our thinking is, as we evolve and move through time, moving this climate space more into the financial sphere is definitely one of our challenges. Now I'll come back to some amplifiers. First, let me talk briefly about risk evolution. I've given you a notion of distribution, both geographies, sectors, firms. Evolution, on the other hand, is much more about projecting forward losses, knowing that the past is not a good guide for the future here, with these climate shocks, which could be manifestly different than what we saw in the past. So 4 different building blocks are basically at the foundation of our scenario analysis. That's the scenarios themselves, so some climate relevant scenarios, which the NGFS, the Network for Greening the Financial System, has been crucial in helping to inform in a consistent way across jurisdictions. The second is really about modeling and uncertainty. And here we've tried to do some work to try and have a consistent approach to this in looking across our membership for models to try and understand how these could evolve. Third is about transmission within the financial sector and thinking about each part of the sector, banks, insurance companies, and investment funds, first of all, as individual adjustment needs. But then in the fourth part, the fourth box to the right here is really about amplification in between sector interactions, considering this body, this European Systemic Risk Board one, is really one that's, I think, our particular comparative expertise is that we really are looking system-wide. We're not segmented. And indeed, climate is probably one of those areas where you're going to see some spillovers. And I'll even show you, I think, areas where that could be meaningful. Now, with this in mind, starting with the scenarios block, and I'll work through the 4 blocks I've just shown you. NGFS scenarios are the ones that we tend to use, all of us, as the basis for having a view of transition versus physical risk as we move along through time. And the transition risk is immediately dominant, and then physical risk with some time becomes the dominant source of risk. And what we see is that current policies as a baseline, this blue one or the yellow here, largely is about greenhouse gas emissions, which stabilize at a high level. And you have then a net zero, which is maybe a bit fanciful at this stage, as we can talk about the conjuncture as we move into the Q&A. But that the idea would you have a meaningful and slow but steady reduction in greenhouse gas emissions. And there's a disorderly one where there's a late but sudden realization, probably when physical risk is becoming more dominant, that adjustment is needed in carbon emissions. And that means you have a sort of dual shock. Your physical risks being manifest at the same time you're jacking up your carbon emissions style adjustment and bringing more economic costs. Now, with this in mind, the right-hand side is about GDP evolution. This is very long term, 2030, 2050, 2100. You can just see by at the end, more or less, we are at the same, at least at the world level, where we'd be in a delayed transition versus net zero. But at the euro area level, there are actually scarring or permanent losses which come with the delayed transition. So clearly, over the long run, it seems based on what we know from current projections, there would be a delay, an orderly transition would be much more preferable to either a status quo, no action, or a disorderly. Now I'm going to trace that through in a couple of slides on banks. First, let me just note, one of the things we've seen in scenarios is, of course, the decision relevant horizon for monetary, fiscal, industrial policy, you name your policymakers, or even financial markets, tends not to be in 10, 20, 30, 40, 50 years, but more 3 to 5 years at most. So we looked a bit more at what could happen in the short term, thinking about some potential acute shocks which would come up to complement these longer term views. And on the left-hand side, you just see a table summarizing some elements of these shorter term scenarios. What I can say on the right-hand side, when you look at the GDP plots here, is that no matter what you do, transition risk dynamics seem to be most relevant in the short term. So if you had a steep increase in carbon prices across all EU countries, you could see GDP losses rise quite substantially compared to moderate rises, which would be really about less material losses in the short term. But it's to get an idea again about the dynamics around that relatively smooth adjustment path I was showing you in the previous slide. What's interesting is if you take extreme flood events on their own, so that's in here, this is the one which have in yellow, GDP line. It has an immediate impact of capital destruction. So basically, it's about understanding that channel. And then as you have rebuilding, it starts to be basically coming back. And insurance plays a key role here where it's available. The other element you could look at as a heat wave, which arguably is somewhat similar to what we saw this summer in Europe, where 2/3 of Europe was at some stage under a heat warning. Was such that you saw a decrease in productivity. And I think that's what we would try to model. And there what you see again is a bit more of a protracted element, but nevertheless one that is short-lived. I think two elements to note here. One is that the physical risk hazards we put in immediately on their own are not significantly there to actually generate significant stress. So what we see is compared to transition, they're much less. Just look at the two axes where they're listed differently. The right-hand side axis, when it comes to the carbon element, is much more meaningful than the left-hand side axis. I will come around to why this physical risk in the next section. Maybe we need to think of it differently than just individual hazards. But for now, just to note, in the short term, it seems at least in the near term, we'll be looking at carbon and elements of transition risk dynamics is the more dominant in the risk profile. Now, if we take this and map this through into a longer term and think about these near-term and medium-term elements, what we see is that corporate PD projections, so corporate defaults, would likely follow then this sort of jagged element where you have an increase in PDs initially with a net zero transition compared to the status quo in credit risk, followed by a steady reduction. If you had a delayed transition, recall this element where you start to jack up carbon prices a lot late and have a framework too late and maybe coincident with physical risk, here you see also then the PDs rise more and are more protracted and come down, but basically at a similar sort of slope thereafter. For the firms which are at the 75th percentile, that's a bit more extreme. Now, what's interesting, that's on the credit risk side, is if you look to the market risk side, the middle and right-hand side panels, either for equities, which is in the middle, or bonds, corporate bonds in the right. Again, you see that there's some short-term pain for long-term gain with a net zero transition, so steady reduction of greenhouse gas emissions. But at some stage, you have forward-looking financial markets, which do embed expectations, which is that there will be less physical risk, say from 2025 onward, giving a boost to equity prices in the net zero. Or in a delayed transition, you have this element of delayed reaction feeding into corporate losses, which are not well distributed over time, but take place immediately, such that there's a big wedge in the evolution of equity prices from forward-looking investors. And that's a dividend discount model type of framework. Right-hand side had more value at risk frameworks, not about valuation changes, but more about actual defaults. And what we see is, again, corporate bonds, you're going to see PDs in market risk becoming more meaningful initially, so both together, and market risk will then subside as you move through time and delayed transition similar. Now, I think taking that forward, what I want to do with these is bring it into the element of financials. And I think that one of the big value adds we had this year is thinking about banks, insurance companies, investment funds in a coherent stress test or scenario analysis modeling, whereby we can project forward losses in different ways and see how that impacts these different entities and compare and contrast. So what we did is we took these identical two forms of long-term and new-term scenarios. You can see in this first two rows of this table, nothing different. We tried to be of the same lexicon for each institutional sector. And here we did ran them through a banking sector credit risk scenario analysis. Here with very granular data on banks, geographies, and using credit registry data to do this, loans to the corporate sector. So really a credit risk exercise. You can see more details here. Insurance sector, in contrast, was market risk. And what we're trying to do here, again, 1,821 insurers, so a lot. It was 2,300 banks. So we're looking at quite a few entities. And here we do on the side of insurers is think a bit more about equities and corporate bonds. We did not touch sovereign bonds, which are a big part of insurers' portfolios for now, but we've focused mainly on the corporate side. Of course, with time, we'll refine, and I think we'll be able to be a bit more encompassing. But for now, I think it gives an idea of illustrative dynamics. And investment fund, it's really, again, market risk, like insurers, so the asset side. And thinking here a bit more about what are the elements that are dominant in investment fund portfolios. Well, here when we take 10,000 plus funds, of which around 50% are retail UCITS and 75% domiciled in the European Economic Area, we see that equities are by far the largest part of their portfolio, around 53%. And this will be manifest when I move forward to take those scenario descriptions and implement them in scenario analyses which are consistently applied. Now, what's interesting here, I think, is a couple of things. And let me first explain what you're seeing. You're seeing two panels. One is net zero. So this idea of gradual adjustments in an orderly way through time, and a disorderly transition where you have late but sharp adjustment at the same time as physical risk manifests itself. Now recall what I showed you on the side of credit risk and corporates and equity and corporate bond risk, is that you said the equity part really is forceful in terms of swinging when you move between banks, insurers, investment funds. It's banks which are credit, insurers, investment funds, market risk, is that the losses in a net zero transition, actually the gains, I should say, are relatively pronounced for what concerns investment funds portfolios, mainly because of the equity component, the forward-looking side, and also insurers. And again, consider insurers here, it's a bit of a magnitude difference, partly because we're restricting ourselves to equities and corporate bonds. Banks, on the other hand, and by the way, when you move to a disorderly transition, that swings entirely to a negative. So the forward-looking markets will price in and you'll have some losses along the way. Banks, on the other hand, is a bit more nuanced. You see a little bit of initial loss followed by subsequent gains. So the intertemporal trade-offs for banks are very, very clear. You might face some upfront losses, but you'll get some delayed gains on credit risk side. And that market risk seeps into credit risk in a sense in this way. So with this idea, I think it's twofold. Again, the takeaway from this, market risk is likely to precede credit risk. And the dynamics will be such that you'll probably see the losses initially or gains resident in market risk relevant portfolios like investment funds, insurance companies, and pension funds. And only with time, you'll see that banks experience the gains. And from a public policy point of view, this is quite important to think about the distribution. Now, I think all I've showed you so far is treating these institutional sectors, banks, insurance companies, investment funds, individually. What if we actually put them together and we ask when they're interconnected, either through the securities or loans? So here banks provide loans to funds and insurers. In all three sectors of cross holdings of securities, you can actually look at what are the first order impacts, particularly in market risk. Again, two panels, net zero and disorderly transition. But let's take the market risk one and focusing on this left-hand side panel, is that the blue bars here are telling us how much first order impacts in terms of market risk will hit banks, insurers, and investment funds in a system, and accumulate them up to a systemic outcome, which will lead to a market gain in the form of a market gain when you have actually a net zero transition or market loss disorderly. Similar to what you saw in a previous chart, what's remarkable here are the yellow parts. And the yellow parts are telling us when they interact, when you have this contagion model, this institutional level balance sheet, you're applying cross holdings in their overlapping exposures, it amplifies gains such that you have around 3 times the gain in terms of the interaction of banks, insurers, and investment funds compared to the first order impacts when it comes to how securities are behaving and moving through the system in particular and lending. So clearly there, and you have a system-wide approach, you can have some amplifications which really do mean that accounting exposures and thinking about only first order impacts might be limited in terms of understanding climate signals. Now, systemic amplifiers, I'll just talk about a couple of things, mindful of time. First, you recall at the outset I talked about physical risk hazards independently. What if they're actually both self-reinforcing, which you can well imagine wildfires, heat stress, elements like water stress are, hurricanes and typhoons, is not often the case. And look, last summer is a good example of this. We had heat stress, which was correlated across many regions. It's not that it occurred in isolation in specific parts of the globe. And indeed, wildfires is part of this. So they are connected across hazards and both self-reinforcing. Hence, you can think about these hazards as potentially embodying a much bigger shock than would be implied by thinking about them just individually and idiosyncratically as sort of IID processes. So hence, a lot of the work we've done is trying to consider where they might correlate and then create a large scope for shock. The other element, I think, which is important is there are overlapping portfolios, which you've seen hints at in the last slide I showed you on system-wide stress testing. And here's just about physical risk. We were rather surprised to see when you look across sectors, so non-financial corporates, households, governments, financial corporations, credit institutions, and you think about just this matrix in terms of cross-holdings, wildfires are actually quite a significant element of portfolio overlap. So if financial institutions are of the impression they can offload when you witness a salient physical risk, it's probably going to be too late, and you'll see that that will not pass through the system as frictionless as might be hoped. On the transition risk side, you can also think about the element of potential amplifications, meaning the numbers I showed you so far with static balance sheets, accounting exposures with some element of financial risk might not tell you the full picture. And here this is about an interconnectedness model with pairwise probably as a default correlations. Now, these tend to be low when you take a broad number of firms. And this is really a very broad number of firms. But if you take this and you actually build in the element that there could be, if you have an emissions relevant parameter governing probably as a default, that if you have those defaults increasing because of emissions intensity, from no intensity through to a very big de facto increase in the carbon price, moderate levels don't seem to lead to much amplification, but extreme levels of carbon taxation increase do. And here you see it in terms of the median pairwise correlation increasing, almost doubling, when you have large transition risk shocks, but also the tails. And you see this positive skew here giving you this element. The high emitting firms in the mix will see a lot of correlation increases in potential issues. And you can see that another way in transition risk in another analysis we had in a report. We did both demand and supply side questions. How much does demand need to adjust across sectors if you want to reduce emissions by a given amount? Now here's just demand. We have also supply in the report. And ask if you had less emissions, which sectors would be the ones most dominant in terms of input-output tables and value chains? How would that propagate through the system again? Idea is you have direct and second round effects. So direct on the industry itself, second round effect through its input-output linkages. And again, what we see is if you have a low increase of effective carbon emission reduction, 10% or 30% larger, the dynamics are relatively similar, such you have first order impacts, direct, but these indirect through input-output tables. And that will translate, and again, by the way, there's obvious suspects here, air transport, coal, mainly about the oil and gas sector. But what you'll also see is that into banks' risk-weighted assets, you think about exposures of banks, it eats in their capital. So for this vertical reduction here in terms of the carbon emissions, you'll see a PD increase, which starts to increase. Now, I think it's less to be focused here on actual numbers, but rather thinking about inflection points where high risk starts to set in. And it gets more and more yellow here as you have risk-weighted assets below their thresholds of maximum distributable amounts start to increase a lot when you get into this area of high carbon reductions that occur rapidly. So with this in mind, I hope I've given you an appreciation of systemic amplifiers. What I would like to turn to next is macroprudential policy considerations before passing back to Fabio. Now, here, I think what I've shown you so far, this is quite a detailed slide. I'll distribute these afterwards. You're welcome to read through the sub-bullets, but let's focus on the blue headings, which is in the cross section, you can see concentrated exposures I showed you initially. And in the slides I've just shown you, systemic amplifying elements which could exacerbate these concentrations. A bit like the subprime crisis, small risk concentrations could imply system-wide losses through the workings in the financial system and also through economic feedbacks. Now, with the time series dimension, what we see is path dependence seems to be there, such that early and sustained action in small increments yields lower systemic losses than if you have abrupt and late adjustments. So there's insufficient in terms of the element of how you're actually reducing transition risk, or ineffective that it's actually not necessarily occurring in the pace or the capacity it should, would result in larger losses. Now, what we did show again is this idea that market risk in terms of dynamics and how they play out, likely to be first, and then presaging eventual credit risk, and that you might have these amplifiers. Now, systemic risk is meant to deal with these elements, both in amplification aspects in the cross-section and risk build-up aspects. So here for the risk perspective, our view is much the same as the Bank of England as a starting point. And they put an October paper last year, I think a very nice way of thinking about this, that industrial fiscal policies are still the first best for achieving climate-related objectives. But you don't want to, and so what risk should be doing, so it's prudential policy should be doing is treating the risk, not the underlying causes of climate change, i.e. you use the world of prudential instruments for resilience purposes, either in a dynamic or static setting, not to provide incentives as such, but would come much more effectively from the actual first best policies in the fiscal and industrial space. Now, having that in mind, you have a macroprudential sort of continuum, which I'll come to in the next slide, and macro and micro. But let me first mention what could be some of the policies. So concentration risk was obvious. I've mentioned to you in many places, risks are concentrated. So you think if you're going to have measures, let's tackle some of those concentrations and think about how they might be best addressed by macroprudential elements to limit financial losses. And buffers are part of this element, and there may be new tools in the mix for banks. And I'll talk in the next slide about banks. Let me first turn to non-banks and quickly mention concentration is similar. You've seen elements where risks are concentrated along the transition, both for banks or non-banks. I think what's important on a non-bank sphere is to underline insurance protection gap will be crucial when it comes to physical risk. So whereas you don't want to put a prudential mandate of trying to ensure credit provision flows in conflict with effectively a climate-related consideration, which is stop lending to regions exposed to physical risk, such that insurance can actually rectify and reduce that trade-off. And if that's the case, I think one attribution in terms of triaging policies and moving them to the right sector is that insurance could actually take over much of this through the protection gap questions. The other element is, of course, no matter what we do on a public policy side, we have to have the view in terms of direct interventions, is that market standards, informational failures are rife in climate, and those need addressing through elements of data, transparency, and the like. More than, before you even think about allocative market failures, at least we can all agree there's informational market failures which are resident here. Now, so there's banks and non-banks who have a triage and, interestingly, policies in both spheres. What I think is key on the side of banks is just to map it out in terms of more details. If we take the existing toolkit, and that's what's most evolved for banks, where would we see measures potentially suitable for addressing climate risk? And here we've addressed some, and we've tried to actually allocate them into microprudential perspectives here on the right, macroprudential here on the left, and then, of course, in the middle, this idea of how they might have some overlapping set. Now, what's important is some of the measures I discussed, so common minimum requirements, so concentration risk measures, either aimed at pricing or at quantity-based restrictions, could fit well in terms of both micro and macro, so institution level versus system level. And elements here that you see through your climate stress testing, transition plan, disclosures, market standards, would not necessarily neatly be able to move to micro and macro, but are certainly in the prudential sphere. What's importantly differentiating micro from macro here is that whereas you have individual banks, we know that systemic risk is not necessarily additive. So safety and soundness of individual institutions might be important to think about, but there might be element of systemic amplifiers, which I've shown you, and elements of interaction which could yield systemic risk for the system. And these could be addressed by these 4 different types of elements in our view, helpfully. One is if you have capital-based measures at the system level, could be in the concentration sphere, it could be others. Bank of England's talked about sliding capital ratios. There's many elements you could have here as the risk starts to increase. You move the capital ratio up with this. All interesting elements when it comes to the conceptual framework. Sectoral requirements, of course, are within sectors, and when it comes to firm level, borrower-based measures. So thinking importantly about households, elements there, who we've not talked as much about in our overlap in terms of our actual data empirics we've shown you so far, because we're focused predominantly on corporates, but they're clearly there. But also inside of corporates, you could have loan to value, loan to income, debt service to income considerations. And lastly, the protection gap, which I've already talked about. Now, all of these things are elements of, so far we've been about a high level 30,000-foot view. With time, I think what we'll find is we'll try to put now in our next phase of work some more detailed thinking into where could we actually do a more holistic mapping. And I'm keen to hear the views of the discussants here. Also help anchor that discussion and bring it forward in more specifics away from the more principles-based to the more operational, which is I think our current homework. But before we do that, let me just summarize briefly and pass back to you, Ernest, which is, I hope today you've appreciated then the scope, scale, and horizon of climate risk all need addressing. What do I mean by that? Scope better linking climate to financial risk, economic risk, scale, more about interconnectedness, contagion across sectors, institutional or economic, horizon in terms of how long-dated shocks could translate into near-term financial stress. Now, we've talked a lot of other things in the report. I don't go through them, but these are the elements here that I'd like to just highlight for now, is this idea of pockets of vulnerabilities that could be amplified, and that along the transition, it might be bumpier. And necessarily the smooth transitions we often see, it's only a long-dated risk would imply. There could be much more upfront systemic risk coming, both from transition and physical risk, as they manifest themselves in ways which are not entirely monotonic and predictable. And with all of this, Macropru in that sense can effectively act as a complement to safety and soundness of individual institutions, system-wide, address, and importantly, risks which cut across sectors. I'm noting the banks tend to have Macropru just focused on banks, non-banks on their individual sectors, either securities or insurance, but obviously there's interactions. And lastly, of course, is an interaction with a broader set of policies aimed at climate itself and not just the financial risk materialization. And clearly there's some conditionality. But with all of that, I pass back to you, Ernest, and happy to hear the views of the discussion and open it up.
Thank you very much, Paul, for this extremely interesting presentation. Now, given your emphasis on interconnectedness and on spillovers and self-reinforcing loops, systemic amplifiers, I think nobody could be better suited than Fabio Natalucci from the IMF to bring in a global perspective. So Fabio, I hand over to you, and I'm very curious about your reactions and your view on this. Thank you.
So thank you very much, first of all, for the invitation. And it's a pleasure to be back here, and also for the possibility to discuss this great presentation. I think they set the bar pretty high for everyone who wants to do work now in the climate work and think about interconnectedness, policy, how to integrate scenario analysis. So it was a really, really great presentation. I'm gonna organize my comments around 3-4 themes. I think one is the one that you just mentioned, particularly interconnectedness. And I think this point of interconnectedness and interlinkages is crucial, and has to do with both the interconnection between physical and transition risk. I think Paul mentioned that, right? Often we treat these two as two separate issues. I'm afraid that what we're seeing in the past few years shows that, in fact, they two cross each other, and they possibly introduce nonlinearities. The other one is across sectors. I think some of the presentation has been focused on the banks, but there are other sectors that have exposure to this physical and transition risk, and where credit and market risk is relevant. I think the one that jumps immediately is the non-bank financial intermediation, right? There's often focus on investment funds that's been done, work that's been done, including at the IMF in the Global Financial Stability Report about a year ago. But the so-called NBFI sector is broader than just investment fund, right? So think about insurance companies. That's an obvious one. Think about physical risk. And so how credit and market risk will affect this sector. You can think of other sectors too, right? Households, for example, as it relates to mortgages, for example, and then sovereign. Sovereign, it's a particularly relevant issue, particularly for emerging markets, right? So if you think about the sovereign bank nexus in EMs, that is a topic that it's really relevant. We have done significant work on that in the April 2022 Global Financial Stability Report, but you can take a slightly different angle. There, the focus was on banks holding of sovereign debt, so direct exposure, the implicit guarantee that banks that sovereign provide, and then the macroeconomic channel, right? The feedback between corporate bank and sovereign again. But you can take a slightly different angle and bring in the climate risk in this assessment as well, right? So for example, lack of insurance policy. To the extent that the government needs to jump in, there's a transfer of risk essentially from the financial sector to the sovereign. You can immediately see how this is an additional channel of this nexus between banks, sovereign, and corporates. And as we think about expanding Paul's work beyond the European Union, for example, this is, I think, an issue that needs to be considered, the nexus between sovereign and bank. Now, why this is relevant, why all this interconnection is sector covered? Because I think the concern of the focus should be on non-linearities here, right? So these are not additive. This could become really non-linear, particularly if there is an acceleration of this physical transition risk. And so think of a situation where you have a tightening of financial conditions. That tightening of financial conditions interacts with the underlying vulnerability, in this case related to climate, and then you get this amplification of the initial shock, and then the impact on the overall global economy could be much larger than what we do when we think about individually of this, either the individually the risk or individual sector. And then finally, the issue of concentration, right? For physical risk could be location, for transition risk could be sectors. So the interaction and interlinkages between this also adds another dimension, which is the cross-border dimension of this, right? So this is not exposure to your own jurisdiction, but also cross-border in terms of EMs is an example. For example, the need to provide private finance to the emerging market. So this is one point that I think it's worth emphasizing. The second one has to do with the use of scenarios. Particularly, I think Paul was looking at net zero and delayed. I think what the Russian invasion of Ukraine has brought to the fore, though, that it's not just disorderly, but it's not just delayed, but could be quite disorderly. And I think the emphasis on disorderly means that the focus should be more on the short term. Obviously, taking a long-term view on these scenarios is very helpful. It provides framing of the issues. And I think the geopolitical events that is now occurring in Europe shows you that you really need to focus also on the short-term impact, right? So in fact, when we do climate stress testing at the IMF in the financial sector assessment program, we're starting to do more short-term stress testing, 1 to 3 years. And I think the reason why you want to do short-term scenarios, one is because it's obvious that this risk is manifesting and crystallizing right now. And so you need to think about the next few years, right? Again, the Russian invasion of Ukraine is an example, but also because I think the short-term focus has more immediate policy implication, right? So if you take a 20, 30-year focus, it's less obvious what the immediate policy implication should be next year. And then there's going to be a bunch of other factors that is going to play a role into the dynamics, right? So think about the assumption of static versus dynamic balance sheet. When you take a very long view, there's a number of factors that is going to come in. It's not going to be just climate that decide what the share, what the size of the balance sheet, the composition of the balance sheet, the risk appetite of financial institutions. There's a lot of other factors there. When you take a short-term view, I think you can actually keep some of the other factors more constant. And so that implies then that there are few observations. If you take this view that we are already in a disorderly scenario, I think one, a short-term focus forces you to take a view on what are cyclical factors versus what are structural issues, right? Again, if you have 20 years, you kind of like can push some of this stuff under the rug. When you have 1 year or 3 years in front of you, you need to decide how much we're seeing now, for example, in commodity markets. It's going to be structural because the geopolitical event in Ukraine have changed the way commodities market operates, market structure, or whether this is just cyclical, right? Because the global economy is slowing. Also forces you to take a view on climate policies, right? What climate policy will be put in place over the next few years? Is it carbon pricing? Is it subsidies like the Inflation Reduction Act in the US? It's something else. You can't avoid taking a stand on the climate policy. You also need to take a stand on macroeconomic policies, right? We see the huge impact of some of these events between COVID and the Russian invasion of Ukraine that is having on inflation, right? So you need to take a stand on what is the fiscal policy that will be in place over the next 3 years. The response so far in Europe and the UK has been with massive, or it's suspected to be, at least in markets, a significant fiscal policy response. You need to make an assumption when you run this more shorter term scenario, and also monetary policy. What will central banks do to respond to rising inflation? Again, in 20 years, you can think about the inflation is back to target. Over the next 2-3 years, even just looking at the central bank forecast, inflation is not back to target. So how will central bank respond? This is essentially to say that you need to consider energy security issue, climate transition, and also efficiency consideration. I think the efficiency part, it's important, right? We can't get to renewables over the next 1 year. But so the efficiency is going to be an important part along this transition. But all this to say that despite the short-term setback, so in the short term, you could see some trade-off between energy security and transition, but in the medium term, the two objectives align, right? You can only reach energy security if you move away from fossil fuel, you move into renewables. Then the third comment I have, it's on the Macropru. I think that Paul got there toward the end, but just a few questions here for him. Right, so essentially, do we have the appropriate right macroprudential policy tool to address this risk, right? Along 3 dimensions. One is, for example, if we focus on corporates, right? we are facing the same issue that we face when we discuss other vulnerability in corporate, right? Increased leverage is an example. So can we use borrower-based tools to address vulnerabilities in the corporate sector? So far, for other structural vulnerabilities, I think the answer has been no, meaning that it's very hard to think about borrower-based. It's easier when you think about mortgages. It's much more complicated when you think about corporates. And so do we face the same issue when we think about climate risk? The other one is, do we have enough appropriate tools to address vulnerabilities in non-bank financial intermediation sector, right? Again, same question for other vulnerabilities. I don't think the answer would be different for climate risk. And so those tools need to be developed if we're just going to focus not just on banks, but we're going to expand the focus beyond banks. The second comment on tools is, Paul mentioned briefly a number of possible tools, right? Systemic risk buffer, concentration limits, sectoral charges, but that implies that you can actually properly measure climate risk. And so I think that is the big issue. Can we actually properly measure risk? So what is the role of disclosure, for example, taxonomies and classification? Those are crucial if you want to think about concentration risk, right? If you can't really measure properly, and data, you need good quality data. So this data, disclosure, taxonomies, those needs to be in place as a prerequisite to have some of these tools in place. Otherwise, it's going to be very hard to deploy these tools. And so, again, this is a prerequisite to go into this, but the quality of climate data, just picking data, for example, it's not necessarily where it should be at this point, right? So much more work needs to be done. Same for disclosure. The IFRS, ISSB is pushing for global disclosure, but we need to get there. And then there is the classification / taxonomies. Not everyone has a taxonomy like in Europe. Emerging market face other issues with taxonomies and more a transition issue. So how to think about those if you want to use these tools? And what about jurisdictions that do not have a public taxonomy? How would you apply some of these tools? Finally, last point, and this is more about the political economy of some of these tools, but how much of action should be done through financial regulation and supervision versus fiscal policies? Because ultimately, I think one of the complaints that you hear from some segment, including here in the US, is that all this action on the financial regulatory side is nothing else than a substitute for fiscal policy. Right? This is truly fiscal policies. And so carbon pricing should be the first best. The US taking the approach of fiscal subsidies. How much is financial regulation here trying to make up for missing action in other fields? And what is the political economy implication of this in terms of mandate, right? Mandate from the public? I think there's a risk of overreach sometimes, and so we need to tread very carefully here to make sure that there is no pushback on some of this action. Those are some of the thoughts, and happy to discuss more.
Thank you so much, Fabio. I think these are, I mean, this was really a very rich presentation by itself. I want to give Paul the immediate possibility to react to some of the points.
Fabio, as always, I think very elegantly put, and also is very rich, as Ernest said. Look, I couldn't go through these and do justice to all of them, but I do think I'll pick up on three areas, maybe not completely aligned with the three things you'd mentioned, but I think they somehow relate. And I've taken detailed notes, as you can see here. So I think first, on the side of models, I agree. We're not there in terms of modeling, and we're not there in terms of the scope. You know? So honestly, looking at corporates is where I think we've had the most data, the most success in linking up data sets and seeing what's happening. But I would fully concur with you that households are super important, as they form a big part of banks' balance sheets in particular, but also sovereigns. Notably that the idea that if you measure systemic risk, you can measure that in 100 different ways. I think the one way which I think often is one we're concerned about is that sovereigns step in, or you need an IMF program, for instance. So with this in mind, I think this idea of where might sovereign step in risk be the greatest scope for this has to come probably from an element of also understanding contingent liabilities, hidden liabilities, and also modeling that sector in a bit better way. So I think that's one of our bits of homework. Noting that the models I've presented today are really very much about financial granularity, financial detail, but I think we still need more of the economic complement, fiscal policy, revenue recycling, elements in terms of government balance sheet strains. So clearly we're going to have to do a lot of this. And in a world where there is probably no one canonical model, we don't want to be Lucas critique. Go back to the 1970s in a different way, which is building these huge models, which are Lucas critique potentially candidates. and think more about maybe a suite of models which do very specific things to help us answer some of these important trade-off questions. So couldn't concur more. I think the second thing you'd mentioned, amongst the things you mentioned, the second thing that really struck me was, of course, this idea that we are in a situation now which is quite illustrative of an energy security concern, which is almost eclipsing the structural climate adjustment need. And I think in that environment, it's kind of a useful and quite salient, I think, illustration of how we have to think about immediate policy trade-offs and how those interact with these longer-term nice-to-haves and the urgency of some decisions that are there. Now, I think the one thing I do like a lot from the IMF as well is that Tobias Adrian had a point about multimodal outcomes tend to come in periods when you have profound changes, the business cycle, financial cycle changes, or other forms of changes. And that you have effectively two modes start to come out, a good mode and a bad mode. And I think we're in the situation now a bit, and that public policy's role is to bring you to the good mode and try to avoid you go to the bad mode, and it creates a self-fulfilling sort of element of scenario which moves in a direction which might be harmful. Now, with that in mind, you'd mentioned some of the elements there in terms of cyclical versus structural. I think what we can safely say at the moment is, currently now, we're in a situation where you don't have the energy capacity that's needed on the green side to meet demand. At the same time, we're seeing a reduction in investment in some brown technologies, potentially, which are meaning that in all spheres we're faced with a supply shock for the time being. So again, what is the role of public policy here? We can think of demand management, so fiscal policy, monetary policy, rightly point out, I think are essential, and models should help us also guide those decisions. But on the side of supply as well, I think there's a big concern to be had here. When and how do you make the adjustment when you have high carbon taxation, de facto high carbon prices? Do you think about when is the right appropriate pace with which that should occur? I think we're really faced with serious trade-offs at the moment with this in mind. So demand management, but also how do you actually move that supply? And that's industrial policy, I think, should not be negated in addition to demand management policies like fiscal and monetary. So I would hope that there's a very detailed thinking that's just taking place here, and certainly we're happy to contribute to that. The last thing I wanted to pick up on is this idea of devil in the details in the policy side. So we think about the narrow prudential questions, so abstracting from these big industrial, fiscal policy, central bank policy questions, thinking just narrowly about prudential. I would fully concur that on the side of corporates, we've had mixed success. So mixed success with some of the tools, either on the side of within the banking sector applying to corporates, or outside the banking sector thinking about non-bank financial intermediaries. And hence some of the general questions we have about how do we increase the effectiveness of Macropru have a specific application here in the sphere of climate. So we shouldn't overestimate the power of climate to actually overturn some of these big debates we're already having, but maybe it could act as a catalyst to bring forward, I think, some needed reflection. Where do we have blind spots, necessarily some leakages and boundaries in the system which need addressing. And here with this in mind, I couldn't concur more in the side of measurement. So I kind of put it as a limited sub-item, but it actually is quite a major item. And I know the work you're doing, Fabio, in the NGFS with the data gaps work is coming to mature, and I think has been very, very helpful in understanding where are the gaps in terms of quantity, quality of disclosures, and ability to aggregate these up to meaningful sort of system-wide or portfolio-wide metrics. So with that in mind, I think a lot of public policy can set, so let's go back to the multimodal thing just to end up. It can set the right dynamics in place such that you go to the good mode versus the bad mode in these uncertain circumstances, in transitions. But of course, much of the heavy lifting has to be in the form of decentralized markets. And I think those markets, in order to function, we know this, whether freshwater or saltwater, economists, you can agree it's really through the element of informational inefficiencies have to be addressed. So here, I think that's certainly a big part of it. So all of this, I think, I don't have simple answers to the points you make, but I think they do help to inform the types of choices you have to make in taking this work forward. One on the side of modeling completeness, two on the side of linking to the conjunctural aspects, and three on the side of thinking about effectively the detailed policy questions, not just the 30,000 feet ones, and where do we think about the existing challenges and policies and how do we actually further those and address them. So thanks very much for that.
Thank you very much, Paul. This is a very interesting interaction. It will become even more rich when now Irene Monasterolo comes in. Irene, please.
So thank you so much for the invitation and for the very interesting discussions. So just a few comments. So we had really big discussion about what the paper does, but I think that the main message is very powerful because so far we still missed from a ECB and overall financial authority point of view an assessment of the relevance of climate, physical and transition risk on the financial system, in particular the conditions and drivers of systemic risk. So this really fills a gap, and because in research and in the literature we started to address the systemic risk of climate change years ago, but this is really a step ahead from ECB and ESRB, and really fills a gap. And also there are, what I found very interesting are some issues that are and topics that have not been addressed so far. For instance, the role of, again, in supervisory reports, for instance, the role of interdependent hazards and how they can amplify physical climate risk, and this pertains all the analysis of multiform and compounds risk. And second, the potential for default cascades of climate risk across firms and banks, and overall role of financial market dynamics on losses amplification, and in particular, very actual for today, potential abrupt repricing of assets that could trigger corporate default and credit losses for banks. And finally, the role of prudential policies, both micro and macroprudential, to mitigate such risk. So I found it very interesting. On a research side, since the report uses, adopts one of the methodologies that we developed together with Stefano Battistone and others, so the climate policy relevant sectors, I thought it could be good to mention that we have an update on that. So we developed, we really got more granular in terms of firms and assets, firms' revenue shares by type of technology, by type of asset, and the forward-looking dimensions, so the mapping in the NGFS climate scenario. So what we did was to develop the climate policy relevant sector granular that we published last week, and to integrate it in a mapping from NACE 4-digit codes, CPRS granular, and the integrated assessment models variables used in the NGFS scenarios. So doing, we developed a tool to support climate risk analysis of financial portfolios using the NGFS scenarios. So here you can see the rationale of the mapping. So what we, why the mapping? Why the climate policy relevant sector granular? Because they, moving from left to right in the figure, actually we start from a high number, so over 1,000 NACE 4-digit codes, so 1,000 codes for economic activities. This is also mapped into NAICS, so the codes used in the US and other classifications. And we, with the climate policy relevant sectors, actually we grouped all the NACE 4-digit codes, over 1,000 codes, into few climate transition risk dimensions, considering not only emissions declared by firms, but also the technology and energy value and role in the energy value chain, the fossil fuel sustainability, and climate policy relevance. Now, as a difference from what Paul showed, where they used the CPRS main, we got much more granular, meaning that now we have over 100 categories of CPRS that enable to discriminate between low and high carbon activities, and thus going beyond the granularity that is not available in NACE codes. From here, we map the activity, the NACE codes, into process-based YAM variables that are used by the NGFS scenarios, meaning that we can assign a climate transition risk profile to the YAM variables and to map them into the NGFS scenario, so to providing us a forward-looking dimension of exposures. And this is important for dynamic stress tests then. Then, let me also spend a few words on why the analysis is relevant. The first is relevant, of course, for fiscal policy, and it's a strong message to EU policymakers in the current geopolitical context of high energy commodity prices and supply-driven inflation. Strengthen the message that we need early and credible climate and energy policies, and use the the opportunity that high fossil fuel prices create for making the transition. On the other hand, if we keep on with the policy incoherence on the energy and climate side, this could be new sources of risk in banks' balance sheets. On the other hand, it has also strong messages for the future of financial policies in the low carbon transition. And in particular, this is the first document that addresses the potential role of macro and microprudential policy complementarity. However, also building up on what Fabio Natalucci just said, how do we design macroprudential policies? Well, there are several, in research, there are several options that we are testing, also together with Laura Parisi from the European Central Bank. On the one hand, we are considering lending limits to high-risk activities, either the introduction of upper or lower ceiling floors on banks' largest exposures. Of course, here a challenge is pertains what type of metrics you use for exposure. The second option is the revision of minimal capital requirements to allow banks to withstand the climate scenarios of the NGFS. Another option could be the introduction of policies that increase the cost of capital for high climate risk firms, like dirty penalizing factor. And the last policy that we are analyzing is the use of systemic risk buffers to address climate systemic risk. However, here a side question that is getting increasingly relevant is what about risk transfer from increasingly green regulated market to unregulated market? And this is a question that we will have to address soon, also from the regulatory side. And about the what role and under which conditions and to what extent green macroprudential policies together also with green monetary policies and fiscal policies could affect economic decarbonization and thus the achievement of climate mitigation scenarios. Recently, with the World Bank and colleagues, we developed a report and published a report which is about the role of green financial sector initiatives in the low carbon transition at era of change. In particular, for different types of green macroprudential regulation, green monetary policies, and green public co-funding, we analyze the transmission channels through which they affect the availability and cost of capital for high and low carbon goods, investments, output, and emissions. We identify for each policy the entry point in the economy, as well as the direct and indirect impacts. And overall, we introduce a theory of change that considers which is structured in challenges, which include, for instance, carbon-intensive structure of our economies, low liquidity, limited development of capital markets in some countries, and low attractiveness of low-carbon investments, such as in terms of cost of capital. It identifies the opportunities for the role of individual green financial sector initiatives, focusing including brown penalizing factor, green supporting factor, green portfolio rewards, green collateral framework, green quantitative easing, and public funding and co-funding. So the most debated green finance policy initiatives so far. We identify the enabling conditions in terms of disclosure and risk assessment. We consider the impact, the outcomes in terms of capital cost and liquidity and de-risking, and overall on reallocation of capital. And finally, we look at the impacts on emission reduction, economic competitiveness, financial stability, and social cohesion. And just to conclude, is an example of what of the analysis that we undertook. This is applied to the dirty penalizing factor where we show in the figure the transmission channels to which a dirty penalizing factor could affect the banking sector and the real economy via higher risk weights assigned to high carbon activities. And here, indeed, the figure shows in the purple box the policy. And then we have up-facing arrows that show positive adjustments, down-facing arrows that show negative adjustments, and the brown arrows are policy impacts on high carbon firms, and the green one are on low carbon firms. And for each and the areas, the pink area identify the direct impacts. For instance, a brown penalizing factor is a directly affect capital adequacy ratio of banks, and negatively for banks that have high exposure to high carbon activities. And instead, the blue ones are the blue areas are the indirect impacts. So from adjustment in capital adequacy, we have adjustment in the cost of capital, so increase for high carbon companies, and adjustment in prices, a direct increase for high carbon goods, and potential low decrease for low carbon technologies. Sorry. And the overall impact on capital productivity, supply and demand for high and low carbon goods, loan exposure, and thus from respectively the implications on emissions from economic structural change and financial stability of the bank at the level of individual bank, so in terms of probability of default, leverage, non-performing loans, and at the level of the system. Thank you.
Thank you very much, Irene. Excellent comments. Very much, again, going beyond what we have heard so far. Paul, what are your reactions to these challenges?
I have to admit, with Irene, I always learn something. And this time, very eloquent and clear as always, but innovative too. So quite frankly, I knew about the CPRS work. And I think, as you've already heard in the presentation we presented earlier, her thinking, they say academia is always 10 years ahead of policy. We're hoping to shorten the lag. But I think Irene and Stefano have been super important in shaping our thinking on climate questions. So that the climate policy relevant sectors work they did early I think is fully fed into what we do. The new and more recent work she cites, I think, is important for us. Because these elements she describes, I think, are super important, technological type. For the moment, we use a broad brush measure, which is emissions. And I think emissions as a means of classifying firms into niche sectors is still rather crude because, of course, the devil's in the details. And I think what Fabio and Irene both mentioned is some ideas about what details might be relevant. So Fabio, a lot on the side of policies. Irene, I think, certainly on the side of technological type, asset type, and forward-looking. I think that's the key thing for us is firms, if you think about risk and how it will manifest itself along a transition, it's not so much that a firm is actually doing green or brown things now. Is that a brown firm becomes greener? That's what will have impact, or the lack thereof will have financial risk associated with it, either in the aggregate or at the firm level. So with that in mind, I think these types of measures are the ones we have to move towards. So it's certainly something we need to implement. The other element, I'd not seen the theory of change in the detail sheet expressed. I think that was a really, really nice way of thinking about it. I would tend to say that indeed, there are also broader elements which she brings into the discussion, which I think are difficult for us to tackle, admittedly with our models in terms of social questions, but they're relevant and in their first order. And we're faced with these now as we speak, when it comes to high energy prices, has a clear distributional impact. And that itself is impacting both transition risk elements and the physical risk impacts as they're manifest in the system. So clearly things we have to think about, and we'll certainly study that because I think that one is an element which seemed very encompassing. And I think it helped us better understand some of the vulnerabilities, triggers, and how those might switch into risk on our side of financial risk. So very encompassing. Lastly, on the policy reflections, I think we're now very much in this space of thinking about policy. I give you a very high level policy discussion, but Irene's points both about the potential leakages and inherent specific focus on banks, but also this element of thinking about the work she's done with Laura, I understand, in terms of different potential tools and how they might apply. Some of them overlap with what we said, but I think there are elements of thinking more carefully. Also, going back to the first point, metrics and measurement challenges she cites are key, because I think the operationalization of these tools, and Fabio had mentioned the same, is going to be our big challenge. So now as we move forward with work, and just to move into the element of what's remaining on our plate, certainly a lot of refinement, and I think today has been very rich in providing us with this, but also the policy questions, I think we need to be much more specific and operationalize these now. And with this in mind, I think the discussants actually both have given me a super rich food for thought, which I will certainly take forward. Mindful of reducing the gap between Irene's innovations and our adoption. I think it took us for the 2017, you mentioned the climate policy relevant sector's initial work, I think it was 2017. So it's taken us quite a while to manage to harvest that one. I hope we're a bit faster in the next setting.
Well, there's a learning by doing, you know. It's always faster, the new adoption.
Well, I think, Paul, you are overly modest. I think the speed with which you push ahead with your work and with your reports is impressive. And I want to say this too. Irene, do you have any immediate comments to Paul's replies?
The comment is, I have a comment in terms really of feasibility and relevance of green macroprudential, green macroprudential policies, because so far the discussion has been mostly on adjustment in capital requirements, so green supporting factor and brown penalizing factor, and there has been interest from the industry saying, okay, dirty penalizing factor or brown penalizing factor will limit our ability to invest. But the point is, even before getting there, I think it's very important to consider, on the one hand, the channel of policy transmission in the economy, given the changing context of inflation and quantities of resources, in terms of, in particular, energy and non-energy commodities. But on the other hand, also consider, the financial characteristics of the banks and financial institutions that we want to target with these interventions, because what we learned from the last financial crisis is that leverage matters, and leverage plus high exposure doesn't mean that if you have a green supporting factor, the banks will lend more to green. That's my comment.
Any final comment from Paul?
Yeah, so two things. One is we are in the policy sphere now having a very heated debate on capital versus non-capital based requirements, and how the mix of these two can actually help bring us forward in a clever application of these. So I think this is a very important point to make. The other one, it is indeed, I think, as Irene rightly points out, and I think Fabio talked about this too, the intersection of financial vulnerability and climate exposure. And that's, I think, we've scratched the surface of this with our report and the work we're doing. But that's something we have to bring forward to really talk about financial risk, because that's ultimately what we're going to have to deal with in the prudential sphere. So as much as we can talk about broader policies, the narrow focus of prudential here is really going to be about this. And Irene's point is super relevant, that we have to focus maybe in the weaker spots in the financial sector, rather than thinking about the aggregate when applying climate tools in the prudential space.
Thank you very much. With this, we're coming to the end of today's SUERF Baffi Bocconi e-lecture on the macroprudential challenge of climate change. Let me again thank Paul Hiebert from the ECB, Fabio Natalucci from the IMF, and Irene Monasterolo from EDHEC for sharing your expertise and your time with us. And let me thank all of you for your interest and for your participation. Bye-bye and take care.
Thank you.
Bye.
Thank you so much.
Thank you.
Bye.